look at Alibaba again today, getting destroyed, down 6%. It's a familiar sight to Alibaba investors, but this time for a bit of a different reason. Usually it's the Chinese government imposing fines or some sort of standards on Alibaba, but this downward move may actually be a result of SoftBank trying to offload its position in Alibaba, and that's what we're going to talk about. And I'm going to be telling you why this is a buying opportunity. Welcome back to another video. My name's Adam. If you don't know by now, Alibaba is one of my largest holdings. I've been consistently buying the dip to the point where I literally am almost losing my shirt. I'm just kidding. Don't invest money you're not willing to lose. But in all seriousness, Alibaba is one of my top holdings. And over the past, year to date, it's actually not doing too bad considering the markets in the US are down by, the NASDAQ is down by about like close to 10%. But over the past year, just getting slaughtered, down 56%. Max, it went public in 2014, traded, well, at least on the New York Stock Exchange. It's only up 22% since then. So, it's represents a steep discount. And the main reason why are the US-China tensions, as well as the regulatory crackdown on Chinese tech companies. However, this has significantly slowed in the latter half of 2021, and I think investors think that Alibaba will not do so well for the fourth quarter of 2022, and they're going to report results relatively soon. I don't think they have a specified date, but I think it should be very, very soon, maybe today or tomorrow. Which is also an interesting coincidence that SoftBank is trying to offload its shares. At least that's the rumor right now. Neither Alibaba nor SoftBank have confirmed this, but that's what the suspicions are. I don't think that they'll be able to sell shares before earnings. And usually, at least past maybe year, Alibaba has gone down after earnings. But I think that this is the turnaround time for Alibaba. One, mainly because China, if you don't know, they have their whole housing crisis with Evergrande. And China's response to that was actually easing rates. So they stopped hiking the rates, and they're actually taking a more hands-off approach, at least in 2022, in the latter end of 2021, where they haven't come down on tech companies like Alibaba as hard. And look, Alibaba is still trading on the New York Stock Exchange. Of course, a delisting is always possible in the future. However, I don't think it's happening anytime soon. I actually used Alibaba's services to buy products from China and resell them in America, and it has worked really well. I'm actually starting thinking of doing a drop shipping business. But anyways, we're going to talk about Alibaba here, and again, P ratio of 16. That's also why I like Facebook so much. P ratio of 17. Almost there. All right, and this is an American company too. They had disappointing earnings and analyst forecasts, but I've just been buying the dip on Meta platforms, down 30% year to date. Oof. So I like these two stocks the most, to be honest, right now. A lot of people viewing this move right here. And again, first, let's talk about why Alibaba's stock is falling. Tech investor SoftBank, which is based in Japan, they're a huge investor in kind of these high-flying startups. Alibaba is not really a high-flying startup anymore. It's a pretty established company. Alibaba on Friday filed with the SEC to register 1 billion American depository shares. The move paves the way for investors to sell shares in a company that have not been traded on the American market before, such as those listed in Hong Kong or held from before Alibaba went public. To me, this is actually good news because this increases the amount of shares available on the New York Stock Exchange. Of course, this can be seen as diluting shareholder value, but we know that Alibaba's intention is not doing that. Alibaba's intention is actually buying back shares, which we've seen they've consistently done. So Alibaba's ADS registration represents more than 120 billion worth of stock that may soon be traded in the US. Such a large amount could signal a looming exit by a major investor. And look no further than SoftBank, which is based on Japan. Of course, these shares are not available. The ones that are in Japan are not available on the New York Stock Exchange yet. The Japanese investment group run by this person owns almost 25% of Alibaba, and invested in the company before it went public. As a result, much of its stake is likely not registered as American depository shares. And I mean, SoftBank is definitely feeling the pinch due to a larger slowdown and sell-off in tech shares. Um, SoftBank owns the equivalent of more than 673 million US shares of Alibaba, and Alibaba's stock fell more than 4%. We've seen it's about down 6%. An exit by SoftBank would come as shares of Alibaba trade at their lowest level since 2017. Wow. A SoftBank exit would run counter to recent trend in investors buying the dip in Alibaba. So, for example, one of Alibaba's now main dip buyers, is Charlie Munger of the Daily Journal, also a close time friend of Warren Buffett, and also he's on the board of Berkshire Hathaway. He doubled down on an investment in Alibaba at the end of 2021 for the second straight quarter. So, yeah, I mean, this also might be because maybe SoftBank needs to sell some shares because maybe they're in a liquidity crisis, because SoftBank invests in these high-flying startups which are mainly down on the year. So maybe, something has to give, and he just decided that it would take too long for Alibaba to turn around. I'm not really sure, but to me it doesn't make sense to sell when Alibaba is literally at their lowest price, or maybe he knows something that we don't, and Alibaba is about to trade a lot lower. I like this article talking about how investor expectations are incredibly low for Alibaba. You're looking at a P ratio of 16 right now, and Alibaba will probably crush expectations. Because one, the crackdown has slowed. Two, Alibaba is a growth beast. They've been growing, by more than 30% year over year. They're a cash flow generating machine, and so earnings per share revisions indicate that investors have become way too bearish about Alibaba. And I think that the good times will start to roll in. I know that there's, on one hand, there's the increase of China's middle class, but on the other hand, I think that there are some tensions due to, of course, U.S. China, but also because of the housing crisis. So that might mean people are spending less. But again, like, Alibaba is a multinational corporation, and they're growing users not only in China but even in America, right? Like, so, oh man, just I think people have been beating down on this stock, and I think I'll be covering the Q4 results. But right now, I predict with pretty high conviction that Alibaba will crush, maybe not crush, but will beat expectations. I mean, $115 stock, like, you're looking at a stock that's priced at its lowest level in many, many years. Let's just take a look over 2 years. What's this chart saying? Like, wow, it's flirting with its lowest levels yet. Let's see what the 52-week low, $108. So I mean, I might wait for 110 to buy more, but like, I mean, at this price, Alibaba I think is a steal. Let me know what you think. My two main stocks that I'm focused on buying right now are Alibaba and Facebook. Let me know if you think this is a good idea. I'd appreciate a thumbs up. Subscribe to my channel if you haven't already. Check out some of the links down below in the description. Subscribe to the Discord. It's totally free. Or join the Discord, I guess. But yeah, love you all. Peace out, and I'll see you in the next one.